You're going to have payroll, you're going to have staff you have to take care of, you're going to have expenses every month. And so you need to be able to account for those. And the better you account for those, the better your underwriting will be.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into another episode of the Freedom Point. I'm your host, Jeremy Dyer, and I have another amazing guest with me today, Dr. Jason Williams. Jason, welcome to the show.
Thank you for having me, Jeremy.
Yeah, absolutely. Looking forward to the topic today. But before we do that, I'm going to get into a little bit of a bio on Jason. Jason Williams is the founder of Ironclad Underwriting Mastery and managing partner of Lorren Capital. Jason has a rich background in real estate investing. His expertise spans from single-family rentals to large multifamily syndications. One of the primary reasons why I wanted to have Jason on the show today is because I often get a lot of questions around underwriting. Sponsors and operators will always promote their deals as being conservative. Well, what does a conservative deal typically look like? And usually you can put it onto what the underwriting itself looks like on that specific deal. So Jason, really appreciate you joining, the show today. Would love for you to maybe kind of give our listening audience a little bit more background on maybe yourself, your journey into real estate, and what you're predominantly focused on today.
Yeah, sure. My real estate journey started about 20 something years ago now when I was in grad school. And I was earning my PhD in chemical engineering. We got our first house. We lived in it as I was in grad school, and then we started renting it whenever I got my first job out of school. So since then we've been doing real estate. We've been doing single families up until about 2017 when I learned about apartment syndication using other people's money. I was like, hey, I can do that. And so that's when we got into multifamily. And I think it's funny. I'm jumping ahead. You were saying, well, what's conservative underwriting? Typically, there's conservative underwriting. You're not going to get any deals. It's really how much risk tolerance you have. And so I always tell people, like, well, we're conservative. It's like, no, you have to figure out what your risk tolerance is, what your risk tolerance is for your investors, for your bank. And I've been told I have conservative underwriting, and I'd laugh at it. But I've had banks come to me to be more aggressive. I've had fund managers approve of my underwriting. So, I mean, I don't consider myself aggressive. I consider it, or conservative. I consider it more realistic, basically, and what you prepare for, what your business, how your business plan accounts for changes like taxes and insurance. I'm in Texas, so taxes and insurance are going through the roof. 40% changes every year. If I underwrote for 40% changes on taxes and insurance, I wouldn't have any deals. So there is always going to be some risk involved. So.
Yeah, well, I really appreciate you kind of highlighting the difference between, conservative versus risk tolerance. I really like to maybe take a step back and really have you explain, what is underwriting in the context of real estate investing, and why is it such a crucial step when evaluating one deal from another?
So in layman's terms, and this is what I tell people who have no idea what underwriting is, it's basically running the numbers on a real estate deal to see if it makes sense, at what price point you can buy it at and still make money. And so in basic terms, that's all it is. But with multifamily, especially with larger multifamily, you're buying a business. You're going to have payroll. You're going to have staff you have to take care of. You're going to have expenses that you're going to have every month. And so you need to be able to account for those. And the better you account for those, the better your underwriting will be. So,
Yeah, no, that makes sense. And I'm glad that you highlighted the fact that when investors are looking to get into real estate investing, especially if they're on the limited partner side, they're really investing into a business. You're not investing into a property necessarily. You're really investing into that business and ultimately the team that's in place to execute and really manage the asset, over the hold period. So again, I'd like to really just kind of unpack, when you're underwriting a deal, okay, what are the key data points or metrics that you focus on, and how do those help inform your decision making?
so I always look at a rent roll. I always look at a T12. A T12 is your profit and loss statement from the last 12 months. Usually you get those from a broker or a seller, and more reputable the management company is, the better records you're going to get. I've gotten rent rolls and T12s on basically legal pad or almost basically a back of a napkin. But whenever you deal with a reputable management company, they're going to have a software where they can give you an Excel sheet or a PDF. So from your rent roll, you can take what your current rents are, you can take all your floor plans, um, your square footages, what the market rents are. Your market rent is what a new lease is going to be going for, not necessarily what the market in the area is. And so that's what I look for. And then the T12, I always look at the trends. I look at a T12, I look at an annualized T9, which is looking at the last 9 months, dividing it by 9 and multiplying it by 12 to get an average, and then an annualized T6, a T3, and a T1, just so I could see what the trend is on that property. There's been many times I've looked at a property that had major rehab. The seller's business plan is to rehab everything and then sell it as it's going up. So a T12 looks dismal. A T9, the first 3 months of the year they're vacant, but then the T9 they start getting more and more occupancy. So like the T6 and T3 look really good. And so I mean it all depends on the type of property, what the original seller's business plan is, and what you can accommodate. So
Yeah, and I would think that, with a T3, a T6, a T12, et cetera, right? I would think that those uh, you know, trailing statements have a story to tell. And how important is it that you know and fully understand, what that story is? And I say that in the context of, when an operator is looking to sell a property, they want that trailing 12 or trailing 3 to look good before they put that property, on the market, or at least get a whisper price from a local broker, right?
mhm.
But that said, I'm just kind of curious to know, how does the current operator story kind of play into, your underwriting process, if at all?
um so generally I like a T12 just because it averages like the last 12 months. But like I said, when a business like if the previous owner's business plan is to drop occupancy to zero and rehab 100% of the units and then build it up, your T12 is going to look dismal. If you just went in not knowing any of that, you're going to look at the T12 and you're going to offer, maybe on a $5 million property, you're going to offer them like 1.5 because that's what your NOI is and that's what the cap rate is. Whereas if you look at your T6, you might be something more competitive because, I mean, they already got a good business, they already got good residents in it. And so they already got a good foundation for you to take it on further. And so you would be more competitive. And the opposite is true too. If occupancy is starting to drop on a property and they're trying to get out of it because they can't make debt service or anymore for whatever reason, you start seeing that T12 versus the T3 and it's dropping dramatically, then you know you're not going to pay the T12 price versus a T3 price because your NOI has dropped significantly. And your NOI, for those who don't know, is your net operating income, which is all of your revenues minus all of your operating expenses. So
Yeah, that makes sense. So, does the underwriting process, just out of curiosity, because I'm an investor in a number of different, asset classes, does the underwriting process typically differ between asset classes? I'm thinking about, multifamily versus industrial versus, other forms of commercial real estate, et cetera.
So I have a base model that I use for multifamily, and I can use that model for mobile home parks. I can use it for self storage. Retail is going to be a little bit different. Typically, at least with a triple net retail, you're going to have a different model to use. RV parks, I've created a whole new model for, really, because that's a whole business in itself with the transient versus like long term resident. But for the most part, if you're going to have leases longer than, say, 3 months, you can use pretty much a multifamily model for.
Yeah, that makes sense. Now, my question for you, and that is related to kind of investors' own, due diligence, processes that they individually go through. Most investors that I talk to, aren't really able to dance around an underwriting, model and spreadsheet very well, right? It's more,
Mhm.
do I trust the operator? Do I trust the business plan? And am I willing to take the risk, so to speak? So, my question for you is really, to the novice investor, what are some specific red flags that investors should be cautious of, when they're looking at an underwriting model?
Um, so some major red flags that I look for are trusting and not verifying. Um, and as an investor, it's going to be hard to do that because you kind of want to trust an operator, but you can vet the operator. You can see who's invested with them or looked at their track history to see what it's been doing. So that would be one way you can do that for an operator. Um, and another thing is a red flag is if you were investing, say, 3 years ago in San Antonio, you are looking at 30% plus year over year rent increases. Now it's negative. They're going down. So if they're projecting year over year of something outrageous like that, you need to just stop right there and go a different direction. And I have seen numerous people doing that, especially toward the tail end of it. It's like, well, they've gotten 30% over the last 3 years, so we can project that going forward. It's like, no, you can't. You shouldn't do that at all. So,
Yeah, that's right. Yeah, absolutely. Trust but verify, but also, do your own due diligence and understand that, the just because we had market conditions in a specific market that looked like X does not mean they're going to look like Y, on into the future. Some operators got lucky if they were, selling properties, back in, 2021 and 2022, right? But
yep.
those operators that were buying, during that time, depending obviously on the market and the debt structure, maybe aren't doing, so well today. So how do you adjust your, underwriting model to account for those types of, market fluctuations? You mentioned rent growth. Certainly we could look at, expanding versus contracting cap rates. We could look at obviously, how debt structure and interest rates, impact, the underwriting model, et cetera.
So, and maybe this is where my quote unquote conservativeness comes in, but I always underwrite with the cap rate expansion year over year. And then if I get a lower cap rate on a sale, that's just a bonus for me. Um, so I always make sure that the exit plan has a higher cap rate than the going in cap rate. For the loans, I mean, we're kind of we've been stagnant on interest rates for a while now. There's rumors that they might drop again, but there's rumors that they won't drop. But if you have a floating rate, you better make sure you have a rate cap. Rate cap is different than a cap rate. I know a lot of people get those confused because they're the same words, just flip flop. And a rate cap is basically a ceiling on what your interest rate is going to be. So if you're an investor and you're looking to go into a deal and you see what their bank terms are and you notice it's floating, you better make sure that there's a rate cap involved in that. I mean, what I tell my students is to concentrate on a single market. I talk to new investors, new wannabe operators, and they're like, "Well, I want to invest in South Carolina. I want to invest in Florida, and Georgia, and Texas, and Ohio," and they're like all over the place. Like, well, you need to concentrate on a single market, know everything about that market, know what you can increase your rents to every year, what your average rental increases are, know what your average expense rates or increases are. And then once you know everything about that market, move on to a different one. And I think once you know everything about that market, then it's really easy predicting trends going forward versus, all right, well, San Antonio's hot. I want to invest there. And Phoenix is hot. I want to invest there. So you're looking at just like snapshots, expecting that to happen for your whole business plan. And that's just asking for disaster that way.
Yeah, I think people tend to have a little hard time spinning their wheels, underwriting 10, 20, 30 deals when the reality is the best in class sponsors that I've encountered, they're writing 100 deals before they ever, enter into a contract on one or decide to move forward on one. So it could become a little bit disenfranchising, I would say for a smaller, operator that's junior in the space to feel like they have to underwrite, hundreds of properties to really learn, that local, market, before they make an emotional decision, to move forward with a purchase. We talked a lot about, cap rates for a little bit here, but I don't want to assume that our listening audience understands what a cap rate is. So I would like for you to kind of explain, that in layman's terms. Many people listening to this may have heard, there's a going in cap rate, there's an in place cap rate, there's an exit cap rate, right? So if you kind of look at, that timeline of acquisition through disposition or acquisition through sale, right? There's different points along that time period where the cap rates could be different in that specific, market with that specific market class. But you also alluded, Jason, to expanding and contracting cap rates. So can you kind of help us unpack the cap rate?
Yeah, so cap rate is actually short for capitalization rate. And all that is your NOI, which I discussed earlier, over your purchase price. So for ease of numbers, let's say your NOI is $1 million and your purchase price is $10 million. That would mean that your cap rate is going to be 10%. Um, so the reason why this is important is because this is how you can force appreciate. You can adjust your NOI. That's getting into a whole other can of worms. But the reason why you want to figure your cap rate is going to be climbing is because if it goes from, say, 10% to 15%, and granted that these are fictional numbers, hopefully it will never change that much. But then you would have to have an NOI of 150 or 1.5 million for that same $10 million purchase price. So what that does is it kind of pushes the numbers against the operator so that they have to perform better on that. But like I said, you're not going to change it by 5 whole points. You're going to change it by a couple at most over, say, 5 years. So
That makes sense. And that also helps me to understand why earlier you said that you like to plan for an expanding cap rate, type of an environment, which helps to, further, make that deal a little bit more, conservative, than not. Because the truth is that that's the one crystal ball that none of us have. And that is we don't know if the business plan is to, renovate, 250, units and part of a value add, business plan, and the plan is to exit in 5 years from now. Do we really know what cap rates are going to be in 5 years from now? And I would argue we don't, right? Which is probably why, you would advise your students and others, to when they're underwriting a deal to underwrite an environment in which case maybe there's a 50 basis point increase in the cap rate, over that hold period. Am I saying that correctly?
Yeah. And also, say you buy a property that's 10 years old. In 5 years, that property is going to be 15 years old. And so the seller or the buyer, the new buyer, is not buying a 10-year-old property anymore. And so you you're just not going to be at the same quality as a 10-year-old property. You can keep maintain all of your maintenance, minimize your deferred maintenance, keep everything up to it, but you're still going to have a 15-year-old property, and they're going to have 15-year-old property problems that a 10-year-old property is not going to have. So that's another reason why you want to increase your cap rate on exit. So
Yep, that makes sense. So for somebody that's brand new to underwriting, what are some common mistakes that you'd advise that person to avoid, early on?
so I know there's a lot of programs out there, and some of them kind of just gloss over underwriting, or they'll give you a spreadsheet and say, here, you just fill this out and have at it, but they don't really go into details of filling it out. And so I actually help people with their existing underwriting, and many times people think they're filling something out right, and I'm going through it and realizing what they inputted did not change anything in the model. And so they're just blindly inputting numbers, not knowing what they're doing, and that's one big thing that I've seen. And another thing is they are in a program, so they trust them. They spend $40,000 for join this program, and so they think that guy knows what he's doing, but they're just arbitrarily following what he says, and he may or may not know what he's talking about. I guarantee you he doesn't know what he's talking about for every single market, so it might not pertain to your market. So that's another issue. And then I think I've only run into one, maybe two people who've actually tried to stress test their model, and most people don't even know what that is. So those are just three of the main things that I see whenever young people are trying to figure out their underwriting.
Yeah, that makes sense. And we might have already spoken to this before, but just to kind of go along with what you're, saying, I'd like to hear, you maybe speak specifically to the sensitivity, analysis, in underwriting, and how can investors really, use that sensitivity analysis to help prepare for potential risks or challenges in a deal.
One thing that I always stress test is the exit cap. What will happen if the exit cap is a lot higher than anticipated? And can I still get decent returns to my investors if that happens? A lot of times, if it goes too high, you might not get anything. But then you're counting on, well, I don't think it's going to go that high. And again, that goes into all your risk tolerance and what you feel you can mitigate, what you feel won't happen or will happen. And so that's one thing. Um, I also um, stress test interest rates. I prefer fixed rates, but until I get that loan product in place, I always run it to just see, all right, well, what happens if I get it at a 6.25? What happens if I have to go into bridge and I'm looking at 12 and a half? Does it still make sense? And I've been in a situation where we didn't have a loan product yet. We're a week out from closing. If I bail, I'm losing $100,000. So I had to go in, figure out, get a bridge debt, which I wasn't expecting. Now, granted, this was a few years ago where a bridge debt was 5.99%, but everything else was sitting like 2.5. So, I mean, it's three times what it was. But now regular rates are 6.25. So it actually benefits us to just keep on extending that bridge debt. But if I didn't check that, I wouldn't have gotten a deal, and I would have lost $100,000. I mean, ideally, you want to have your loan lined out so that whenever you sign the documents, you get the bank to do whatever they need to do in the same day and move on. But that doesn't always happen.
Yeah, absolutely. Let's talk a little bit about your businesses, Ironclad Underwriting Mastery and Lorren Capital. What's kind of next for those businesses? As we kind of move into the fourth quarter, 2024 and beyond. Are there any specific goals or bucket list items that you'd like to achieve?
Well, Lorren Capital, we're constantly looking for new deals. I was looking at 2 deals this morning with my partner on what we're thinking we can do. Um, we like to be in certain markets. Like I said, I like to concentrate on one. I'm in Texas. He's in New England, and so we were kind of looking at a deal up there. Um, so we're constantly looking for new deals. We're looking at a ground up construction of a mobile home community. I'm not necessarily limiting myself to multifamily, but we are looking to acquire more properties. With my Ironclad Underwriting Mastery, I I created this course sort of out of people just coming to me and asking for it. And so I've created an online course where people can come do it at their own pace. They can hop on a call with me. We can figure it out. I have like hold office hours on it. And so I'm just going to keep pushing that. Um, I met a lot of people at a conference last week, which was pretty cool. And so we'll see where that goes. I'd like to get more students, but um, a lot of people want a fish. They don't want to learn how to fish. And so that's kind of where I am now. It's like, well, can you underwrite this for me? It's like, I'd rather teach you how, but I can.
That makes sense. Well, what would be a couple of different ways that our listening audience can learn more about you and connect with you?
So I'm on LinkedIn. LinkedIn is probably the best way to get a hold of me. I think it's Jason Nell Williams, PhD, something like that. I also have an Instagram, Ironclad Underwriting Instagram. I got Ironclad Underwriting YouTube channel. Um, we've been putting a lot of new content up on those too. So even if you don't want to reach out, but you want to learn anyway, you can by all means go to those 2 resources. Um, and you can always just go to my website, which is ironcladunderwriting.com, where you can get access to me, send me emails, and sign up with a time, and we can discuss further if you have any issues. So
That's great. Well, we'll go ahead and put those links in the show notes for this episode. Jason, really appreciate you being on the show today and providing our listening audience with some tremendous value.
well, thanks for having me. I appreciate it. And I hope I was able to add good value. So
Absolutely. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.